Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. In 2014, economist Richard Werner conducted an experiment inside a small European bank that challenged one of the biggest lies that most of us have ever been told when it comes to money. He went inside an actual bank and observed the lending process while a real loan was approved. The bank didn't open a vault and remove money that another customer had deposited. No one called the central bank and asked for permission to print new money, and no one transferred someone else's savings into the borrower's account. The bank simply entered a number into its accounting system, and at that moment, a new bank deposit was created. In that same year, the Bank of England published an official paper explaining the exact same process. Commercial banks just create deposit money when they make loans. Most people find that difficult to believe because we assume that money creation must be controlled entirely by the government. But the basic mechanism is not that complicated. When a commercial bank approves a brand new loan, it typically creates a new deposit in the borrower's account. That deposit can then be sent throughout the economy just like money from a paycheck, a business sale, or a tax refund. So the banking system is therefore not simply moving existing money from one person's account to another. Banks can expand the amount of deposit money circulating in the economy when they extend credit. And by the end of this video, you'll understand how banks create money, what actually limits them, and where that money usually flows, and why that direction of bank lending can make it easier for some Americans to build wealth, while it can be much harder for others just to get started. Once you understand this, you'll never look at mortgages, business loans, credit cards, housing prices, or the money inside your bank account the same way again. So without further ado, let's get right into the video. To understand the system, you first need to understand that not all money is the same. Now, the first form is central bank money. In the United States, this includes reserve balances that commercial banks hold at the Federal Reserve. Consumers cannot spend these balances directly. They are mainly used to settle payments between financial institutions and support liquidity. The second form is physical currency, meaning the paper bills and coins that are in your wallet. Now, cash is important, but it represents only a relatively small portion of the money that Americans use every single day. In fact, physical dollars and coins make up a surprisingly small fraction of the total money supply, typically between 5 and 10%. The vast majority of money, about 90 to 95%, exists purely as digital data on computer servers, reflecting balances in checking accounts, savings accounts, and other bank accounts. Which brings us to the third form, and that's commercial bank deposit money. Now, this will be the number that you see when you open your banking app. It's the money that you use with a debit card. It's an ACH transfer or a payment app. Most money used in the modern economy exists in this digital deposit format. Unlike physical cash, aka central bank money that's printed by the government, this represents the vast majority of our money supply, and it exists purely as an account entry. This is that remaining 90 to 95% that we just spoke about, and that is the part that most people never really think about. The government produces physical currency. The Federal Reserve creates central bank reserves, but the commercial banks, they create a large share of the deposits that we use throughout the economy by making loans and purchasing certain assets. Now, let's talk about that a little bit more. Now, the traditional explanation sounds like this. You deposit $1,000 into a bank account. The bank keeps a portion in reserve and lends the rest to someone else. That borrower spends the money, it gets deposited into another bank, and the process repeats. You may have heard this described as fractional reserve banking or money multiplier. Now, that explanation will introduce the concept, but now I know it doesn't accurately describe how an individual bank normally makes the loan in real time. If banks truly depended on our deposits to stay alive, they would be competing aggressively for our money. They would offer 10%, 12%, or even 15% interest just for the privilege of holding your savings. But that's not what happens. Most banks pay depositors little to nothing because they don't need to wait for someone to deposit $10,000 before they can actually lend $10,000 to someone else. Now, that should raise an obvious question. If the money is not coming directly from another customer's savings account, then where does the loan money actually come from? And the answer sounds almost unbelievable. The bank creates it by entering those numbers into its accounting system. To understand how it works, you need to understand double entry bookkeeping. A bank's balance sheet is divided into two sides. One side records the bank's assets, meaning what the bank owns or is entitled to receive. The other side records its liabilities, meaning what the bank owes to other people. Every transaction must be recorded on both sides. Suppose a bank approves you for a $10,000 loan. The moment you sign that loan agreement, the bank records that as a new $10,000 asset. That asset is your promise to repay the loan plus the interest that's attached to it. In other words, the bank now owns the legal right to collect your future payments. At that exact same time, the bank adds $10,000 to your deposit account. That deposit is recorded as a liability because now the bank owes you $10,000. You can transfer it, you can spend it on a debit card, you can withdraw it as cash, or you can use it to pay someone else. The point is that in one transaction, the bank creates a $10,000 asset and a $10,000 liability. On one side, you owe the bank $10,000. On the other side, the bank owes you $10,000. Both sides of the balance sheet increase at the same time, even though the money was not removed from any customer's account. The deposit was created when the loan was issued, and that is the basic mechanism behind commercial bank money creation. And this next part may shock you even more. Banks are no longer legally required to hold a specific amount of deposits in reserve before creating new loans. In March 2020, the Federal Reserve reduced the reserve requirement rate from all depository institutions to 0%, effectively eliminating the traditional statutory reserve requirement that once placed a limit on fractional reserve banking. Which means the only real limit on how much money a bank can create is who they decide to lend the money to. Now let's go back to our loan example. The bank entered $10,000 into your account and that money became real enough that you can actually spend it, right? You can use that money to buy equipment, you can pay bills, you can cover an emergency, or purchase almost anything that you want. Then over the next 5 years, you repay the bank month after month. But unbeknownst to you, every loan has two parts, but most people only pay attention to one of them. The first part is the principal. That's the original $10,000 the bank created as a deposit in your account. The second part is the interest. So let's say that over 5 years, you pay the bank an additional $2,000 for the privilege of borrowing that money. When you repay the $10,000 principal, that money doesn't get transferred into another customer's account. It doesn't get placed inside a vault so the bank can lend that same money out again. The principal is effectively removed from the banking system. The loan created a new deposit when it was issued, and as you repay the principal, that deposit money is gradually being destroyed. That same accounting system that created that money reverses the entry as the loan is paid down. So banks don't only create money when they make loans, they also destroy money when those loans are repaid. I know that sounds almost impossible, so let me give you a thought experiment that makes the basic mechanics easier for you to understand. It's not a perfect legal comparison, but it reveals something happening underneath the surface. Imagine a bank will rent you a house, except the house itself doesn't actually exist yet. The moment you sign the rental agreement, the house just suddenly appears. You can live in it, you can sleep in it, you could do whatever you want, and for the next 20 years, you make real monthly payments to use it. Then, after you make the final payment, you return the keys and the house disappears just as quickly as it appeared. It's no longer sitting on a plot of land. It's not going to be rented out to someone else. It simply vanishes from existence. The only thing the rental company permanently keeps is the money you paid for the privilege of using it. Now stop for a second and replace that imaginary home with a bank loan. The deposited money is created when the loan is approved and credited to your account. As you repay the principal, that newly created money is gradually erased. But the interest you paid over those 20 years, that's completely different. That interest does not disappear. That is income that the bank actually keeps. Now going back to our loan example. In our example, the bank created a $10,000 deposit. They collected, let's say, $12,000 in total payments. They canceled the $10,000 principal as the loan was repaid, and they kept the remaining $2,000 as interest income. It's almost like the bank allowed you to use a home that it created through accounting entries, it made you pay real money every month to use it, and then it erased the home after you paid it off. Now, I know all of this will sound like very, very weird, but the point I'm trying to make is that you have to think outside of what you've been told and what you just traditionally know, because that will bring us to a very important question. If banks don't need to wait for someone else to deposit the exact amount of money they want to lend, and their primary limits are profitability, regulation, capital, liquidity, and risk, then who do they choose to lend money to? And the answer is usually not the person who needs it the most. It's the person that banks believe is most likely to repay them and to make them a profit. And usually it's not you and it's not me. Now, one question that always bothered me was, where does the money go? And I'm going to start by telling you where it doesn't go. It doesn't go to small business owners. It doesn't go to entrepreneurs trying to create something new. And I'll explain why. The problem is that the system rewards banks for creating money and directing it towards one specific place. If you walk into a bank tomorrow and ask them for $50,000 to start a small business loan, they're going to question you for weeks. They're going to want to see your business plan, your tax returns, your financial projections, your personal credit, your business credit, your collateral, bank statements, and proof that you can actually repay this loan. And you'll provide them all of that, and they'll still deny your application. Now, walk into the same bank and ask for a $400,000 mortgage to purchase a house. Suddenly, the conversation becomes completely different. Now, in many cases, getting approved for a much larger mortgage is easier than getting approved for a smaller business loan. And why is that the case? Because lending money to a business is much riskier for the bank than lending money against the house. Some estimates would suggest that business lending can be nearly 3 times riskier than mortgage lending. If your business fails, the bank may lose a large portion of the money that it lent to you. But if you stop paying your mortgage, the bank can foreclose, take possession of the house, and sell it to recover its money. So put yourself in the bank's position. If you could create new money and decide where to lend it, where would you put most of it? You would probably put it into mortgages. And that's exactly what happened. Look at what happened in the United States between 1997 and 2011. In January of 1997, American commercial banks held about $1.13 trillion in real estate loans. By December 2011, that number had climbed to nearly $3.5 trillion. That is an increase of more than 200%. During that same period, commercial and industrial loans, that's the category to measure traditional business lending, grew from about $782 billion to $1.3 trillion, and that's an increase of roughly 67%. In other words, banks added approximately $2.36 trillion to their real estate loan balances, compared with only about $522 billion in additional commercial and industrial lending. That means the increase in real estate lending was more than 4 times larger. A huge portion of the new bank credit entering the economy was not financing entrepreneurs who were starting companies or hiring workers or creating new products. It was being directed towards property and assets that already existed. Now, I want you to watch what that does. Banks create trillions of dollars in additional credit and direct it into real estate, but the number of homes does not increase nearly as quickly. You now have far more money competing for a limited supply of property. You don't need to be an economist to understand what happens next. Prices will start to rise. You've probably heard that housing is expensive because of supply and demand, or there aren't enough homes, or there are too many buyers, or immigration is increasing demand, or foreign investors are purchasing properties. And there may be some truth to all of these explanations, but one of the biggest forces driving home prices higher, the one that rarely gets explained clearly on the news, is the expansion of easy mortgage credit. Every time a bank approves another mortgage, new deposit money is created inside the banking system. That money flows directly into the property market and helps buyers bid home prices up even higher. The bank is not simply helping someone purchase a home, it's also increasing the amount of money competing for the same limited number of homes that are currently available. That pushes up the price of the same home that you're trying to buy. And this is also one of the reasons why your parents were able to purchase a house at 24 while you're 30 years old, working harder than they ever did, earning more money on paper, and still struggling to escape renting. It's not because you're lazy, it's not because you failed, it's because the rules of the game, they changed and nobody bothered to explain the new rules to you. But now you know, and if understanding this makes you angry, then good. I want you to hold on to that feeling. Because the system was created by people, which means it can also be changed by people. Remember the Professor Richard Werner from the beginning of the video? He didn't just prove how banks create money, he also offered a solution of how the system could work better. Werner is one of the authors of the book that this video is based on, Where Does Money Come From? And according to him, we don't need to destroy the banking system or rebuild the entire economy from scratch. The problem isn't simply that banks can create money through lending. The real problem is where that newly created money goes. Let me show you exactly what he means. Imagine a bank creates a $1 million loan for someone purchasing an existing house. The buyer receives the mortgage, the money is transferred to the seller, and the seller now has $1 million sitting in a bank account. But what did that loan actually create for the economy? No new houses were built, no new factories were opened, no new products were developed, no additional workers were hired. The exact same house simply changed ownership. More money entered the housing market, but the number of houses stayed the exact same. And when more money begins to chase the same limited number of properties, prices will rise. The loan itself created more purchasing power, but it didn't create more economic output. Now consider a completely different scenario. A bank creates a $1 million loan for a small business owner, and that business owner will use that money to hire 10 employees, to purchase equipment, to lease a building, to expand production, and develop a new product. Now something real has been created. There are more jobs, there are more production, and there are more goods and services that are currently available. This will also create more income circulating throughout local communities. It's the same banking system and the same amount of newly created money, but the outcome is completely different. One loan primarily pushes up the price of an existing asset, while the other loan actually expands productivity and the economy. One makes it more expensive to purchase something that already exists, while the other helps create something that didn't exist before. Once you understand that distinction, the solution becomes very obvious. Why not direct more lending towards small businesses, entrepreneurs, manufacturers, and people who actually create jobs? The problem is that larger banks often have very little incentive to create small business loans. Processing a $50,000 loan for a local business can require as many steps as processing a multi-million-dollar loan for a corporation. The bank still needs to review financial statements, tax returns, credit history, cash flow, collateral, legal documents, and the borrower's ability to repay. The paperwork may be similar, but the potential profit is dramatically different. From the bank's perspective, why spend time processing dozens of smaller loans when one massive corporate transaction could generate significantly more revenue? That's why so many small business owners struggle to access capital, even when their businesses are producing revenue and serving real customers. It also explains why your personal and business credit can have such a major influence on the opportunities that are available to you. We may not be able to personally redesign the banking system overnight, but we can work to put ourselves in a stronger position when we need to operate within it. And that starts with understanding exactly what's appearing on your credit report, identifying information that may be damaging your credit profile, and then taking action when something is inaccurate. That's where a tool like Rising can help. Rising is an all-in-one DIY credit repair platform that gives you access to your credit reports and scores while also helping you understand what may be hurting your credit profile. Instead of simply showing you a score and leaving you to figure everything out on your own, Rising provides tools that actually help you take action. You're able to create customized disputes from the website or the mobile app. You can track the responses, and you can use the automail feature to send your disputes through Rising. It's also very easy for you to start. All you have to do is click on the game card that's inside of the website or the mobile app, and you can watch a 7-minute video that shows you step by step how to actually use this. You should use Rising as your 90-day credit improvement system to stay organized and follow your progress throughout this process of rebuilding your credit. Rising also includes up to 24 months of rental and utility trade lines that can back report your payment history up to 24 months. So that is 2 years of on-time payments that can instantly be added to your credit profile. Right now, you can access your credit report through Rising's $1 7-day trial. I'll leave a link in the description. There will also be a clickable link right here on screen. Now, improving your personal credit can help you navigate the current system, but it doesn't solve the problem that Professor Werner was describing. To change where money flows throughout the economy, Werner argues that we need a different type of banking structure. We need more small banks, not just a handful of enormous institutions that are focused on billion-dollar corporations and massive financial transactions. We need banks where decision makers know which local restaurants stay crowded, which contractors consistently have work, and which entrepreneurs have been serving the community for the past 10 years. A computer algorithm sitting hundreds of miles away only sees a credit score and a spreadsheet. A local banker may be able to see the actual business behind those numbers. That local knowledge can make small business lending more practical because the bank has a better understanding of the people, the industries, the economic conditions, all within their communities. Small businesses are responsible for an enormous share of the employment across advanced economies. And when those businesses cannot access capital, they cannot hire additional workers or purchase equipment or open new locations or invest in expansion. The jobs that could have been created never appear, the products that could have been developed never reach the market, and the businesses that could have grown remain small, while more and more newly created money continues flowing into existing assets like housing and financial markets. The result is an economy where asset prices keep rising even while ordinary people feel like they are barely moving forward. At this point, you may be thinking, well, this all sounds good in theory, but has any country actually tried building an economy around a large network of smaller banks? Werner frequently points to the development strategies used across parts of Asia, including China. When Deng Xiaoping came into power in 1978, China began studying the systems used by countries like Japan to understand how they achieved rapid industrial and economic development. One important part of China's strategy was expanding access to local and regional banking. Instead of expecting one centralized institution to understand the credit needs of an enormous country, China developed thousands of small banks and lending institutions that could operate closer to the local businesses and communities. The logic was very simple. A small group of people sitting in one central office cannot possibly understand the needs of every factory worker, every farmer or shop owner or entrepreneur across an entire country. But thousands of bankers working with individual communities can make decisions based on what is happening directly in front of them. China's economic growth was obviously influenced by many different policies and historical factors, but directing large amounts of credit towards infrastructure, manufacturing, businesses, and productive development played a major role in that transformation. The country didn't need to eliminate bank money creation. It directed more of that credit towards building factories, transportation systems, products, businesses, and productive capacity. The issue was never just whether banks should be allowed to create money. The issue was whether that money would be used to inflate the prices of something that already existed or help create something new. So you're probably thinking, why is it that so few people understand this? Because most of us were never taught how modern money actually works. You can study economics, you can study finance or business for years, and you'll still walk away believing that banks simply collect deposits from savers and then lend that money to borrowers. The deeper mechanics of credit creation are rarely explained in a way that ordinary people can understand. I want to thank you guys so much for watching this video. And before we wrap up, I want to talk about what all of this actually means for you and what it means for me. We exchange pieces of our lives for money. Every early morning, every late night, every hour spent away from the people that we love represents time that you can never get back. Your time on this planet is limited, and when you work, you're trading that limited time for income. So in that sense, money is stored time. It represents the hours, the effort, and the energy that you have already sacrificed. So when new money is created and prices rise faster than your income, it's not just a change in numbers on a screen. The purchasing power of the time you already work for is being reduced. The same hour of your life buys less food, less housing, less transportation, and less financial security than it did before. That's why understanding how money is created really does matter. The system doesn't only affect economists, bankers, and politicians, it affects everyday people working just trying to make a living. And if you got any value from this information, please like, and more importantly, I want you to share this video with at least one person today, because we cannot change a system that doesn't understand. I genuinely believe this is one of the most important financial topics of our generation. And as always, I want to thank you guys again for watching. I truly appreciate it, and all of you have a wonderful day.